Good day, fellow investors. I just got this email from one of my brokers discussing the most bought European stocks last month. And I went to research into those stocks because that's what I do. I just look at thousands of stocks over a year. And here is my analysis of these three most bought European stocks. We have ASML, the chip producing machine maker. We have BAYER, that is going down and likely people see it as bottoming out and therefore value investing. VolksWagen, the same, with a very high dividend yield, and we have to see whether these are value traps or not, and whether ASML is fairly valued. But just before that, let me give you a commentary on the European market. We have seen things really going up since the 2022 recession scare, but over the long term, not much returns there, and stocks are going up despite the fact that Germany will likely be in a recession this quarter, next quarter, and everyone is expecting lower interest rates by the ECB that should then inflate again financial assets. So people are betting on inflation, which is not that bad from a bet, but maybe you could find a little bit better things, and we'll discuss the three stocks that are most bought. So estimations are negative 2 quarters in a row, it is a recession, and then somehow things will again linearly improve, but okay. Now, the market is higher on expected lower rates, so now a recession is good for stocks. Last year a recession was bad for stocks, the market. But when it comes to investing, you want to base on fundamentals, and that's what we do here and what I do on my research platform. We are value fundamental-based investors. Sticking to the market, as I said, we have positives, protection from inflation through the debasement of euros, and negatives, we have market valuations that are pretty high, except for BAYER and VolksWagen, but relatively high for ASML. Let's check. What they are doing, they are moving technology forward, and they are the absolute leaders in the machines that are used to produce chips, especially new generation chips that NVIDIA is using for ChatGPT. And we look at the numbers, 27 billion in net sales, 8 billion in net income, but if I compare that to the market cap of 368 billion, I'm trading at 15 times sales, and given the high margins, a P ratio of 44. However, I wanted to show you something very interesting here. Earnings per share are now 20 euros. The stock price 14 years ago was 40 euros. If the company grows these earnings again significantly, and the future earnings are 50% of the current stock price, this will be a great investment no matter what. However, this spike here tells me that there is risk, and also the stock is up 25 times from 40 to 900. However, earnings didn't increase 25 times. Earnings went up just 6 times from the 3-something to 1991 now. So when you look at ASML, yes, they are the leaders. The P ratio, we'll see later, might not be even that high because they are the leaders. They have had great growth in 2023. It will likely stall in 2024, but then regain fast growth again 2025. The bull case is the following. They have a monopoly in advanced lithography. They have a unique position to benefit from the AI boom on more complex chips, and they are undervalued in the long term, which is what those buying now are betting on. The stock going higher, but also being undervalued in the long term. I digged a little bit deeper, and the key risk I see is the race risk. Yes, AI is changing the world, but now I feel that buying the stock now is like chasing that race and ASML is winning, but if there is just a delay in these estimates, earnings estimates, where those grow 47% in 2025 after not growing in 2024, and then 20% going forward. And if you look at the earnings, as I said, the P ratio of 50 is not much. If earnings double in the next 3 years, then you have a P ratio of 25, which is nothing for a dominant position in the market. So that is the possible reward. And if they grow like this, the P ratio will stay at 50 and you double your money even from these levels. I can understand that reward, but you have to keep in mind also the risk that if that doesn't happen, if this is 10% and 5% on a 2-year delay in the AI revolution, then the stock will crash like it did from here to here. So that is the risk and reward. And when it comes to buying this, okay, you just need to have the right exposure, because it is very hard to see where will demand be in 2029. How will the competition look like? You are now buying the past, which is great for ASML, but the outlook is hard to see. Therefore, I would put this into the category of bets, and you have to see how much you can bet with your portfolio on this. I wouldn't bet much, and if you are betting, then you should had also bet here, which is the key to understand, because if you didn't bet here, you are likely playing the following game, and every technological revolution, like the current AI revolution, as we discussed in a recent GMO video, has been accompanied by early massive hype and stock market bubble as investors focus on the ultimate possibilities of the technology, pricing most of every long-term potential immediately into current market prices. And many such revolutions are, in the end, often as transformative as those early investors could see, and sometimes even more, but only after a substantial period of disappointment during which the initial bubble bursts. So I am not taking those bets, and I'm more of a value investor. So maybe when the bubble bursts, like we did with Intel a year and a half ago, maybe it will be interesting again. But until then, this is too crazy for me. Before going on to the value plays, let me just share that there are plenty of value buys on my research platform. If you want to accumulate wealth over the long term by buying value investments across the world, maybe my research platform is something for you. Check that out. Let's go on to BAYER. And if I look at the stock price, it has been absolute destruction, especially the last year. They have recently had a capital markets day, and when you look at their presentations, regain flexibility, reduce debt, managing those expiring pharmaceuticals, and focusing on industry-leading performance. So all things that they had not been doing the last 5 years, but now they suddenly will do it. And yes, they are a global leader in health and nutrition. They have even increased their sales a little bit over time, but now they have a new CEO, and the challenges, pipeline, litigation, high debt, and bureaucracy. And the new CEO will solve that all, cut the dividend, and maybe even break up the company, not for now, but over time, creating future optionalities. Very, very interesting words. Rapidly rebuild early and mid-stage pipeline because of their loss of exclusivity on a few of their drugs, litigation, taking a fresh look at things. What the kind of sentence is that to put in a presentation? You are the CEO of a company and you will take a fresh look at things. Okay, you didn't say anything, and that's why the stock is tanking. High debt, that's a certainty, it is there. They will, of course, fortunately, cut the dividend, and that also puts pressure on those dividend holders that are selling the stock And therefore, I think this is the most bought stock because people think that it is oversold. But we need to look at the fundamentals, and there is also bureaucracy, which is a factor in Europe that is present with these legacy companies, and it's a hard one to tackle. I'm looking at what they will do differently. They will do a miracle and save 2 billion. If we look at the outlook negative for 2024, free cash flow 2 to 3 billion, which is something, but you have to take into account this debt pile, which is now larger than the market cap. And if there is 2 billion of free cash flows, to lower it to, I don't know, 1 times EBITDA, it would take 5 years of just lowering that, and that will not be easy because there simply isn't much money. When the cash flow was 5 billion, but look at these litigation costs that are continuing to pressure the company. And yes, litigation, 13 billion has been spent on those, and likely that will continue going forward, unfortunately, because they have their plans here, but the adverse effects can be more settlements and defense payouts, which is really, really important. And then there is also severance payouts on those legacy employees. However, there are also always fancy words there, impairments finally that come when there is a change in management, cleaning the kitchen sink, how they say. But this is the reality. They will see declines going forward, and hopefully there will be something to replace this. But this is what I want to discuss. Let's look at the management. And we have now a new CEO that was CEO of Roche Pharmaceuticals in 2019, but another leadership change in 2022. Anderson departs as pharma CEO because in 2022 the sector's fortunes declined with several clinical setbacks. What is the hope for Bayer now? And he is leaving to pursue other opportunities. And he left the boat before it started sinking there with Roche. And that's the key here. The management, we can change the story, but it's hard to change the company. Further, look at this. Another board of management, Rodrigo Santos, he has been there in Monsanto since 1999. But when you see people that have been there for 25 years, how are they going to change the mentality of the business? They will not. Further, just discussing these European companies, they felt great. Today is a great day for our customers, farmers around the world, when Bayer closed the Monsanto acquisition. And that acquisition started in 2016 already. They closed it 2 years later. But if we look at the glyphosate issue, it already started in 2015. So Bayer could have known, Monsanto surely knew, but Bayer went and bought it and thought it would do great. But Hugh Grant, Monsanto's chief executive officer, left the company and received a payoff of approximately 77 million post-sale. So this is the incentive of the management. And as Munger always says, look at the incentives of the management and that will tell you the outcome. Yes, the stock is cheap, but nobody wants to get into that bag of worms, to put it in an agricultural framework. And maybe it will rebound, maybe it will not rebound, but you are not being paid for it to rebound 50, 100% in the next few years if they can turn around ship. As you know, with turnarounds, as Warren Buffett said it, those seldom turn around. And if you have 10 of those in your portfolio, maybe one will turn around too, but it will not be enough to give you a profitable return on the strategy. It's much easier to live by buying great businesses, better businesses. So to summarize, 2 billion of free cash flows on the market cap, 10% yield, but the debt doesn't allow them to repay you that. Therefore, I would say something not to build your wealth on. Maybe it will go up as a stock, but I'm not interested. VolksWagen, 7% dividend. So you would say, Sven, here I'm being paid to wait, right? Well, the destruction has already happened, and a lot of value investors think that with a P ratio of 4, 3.5, this is too cheap to pass. There is a new team, technology at scale, unleashing new brands, new steering model, regional leadership. All things are great, sales are up, therefore the cheapness, profits are up, margins are strong. However, Germany is about to enter a recession, but that you would say already priced in. It's a global company, so sales are global, but 10 billion of automotive cash flows. Compare that to this, we are at a price to free cash flow of 6, which is extremely cheap. However, net income is also great. If we look at the outlook, cash flows are already projected to be half, and nobody is projecting a recession because sales are expected to be 5% up. There is capital allocation. If you look at the capital they have, a lot goes into research and development and into capex. This is huge, and only this is spent on shareholders. However, I'm looking at sales around the world. Europe recession is still 40% of the market, the rest is China, and I don't know whether the Chinese will keep buying European cars or there is huge competition, and you can see already the decline in sales there. But the most important thing when it comes to automotive investments is this. This is a speech from 2007 from Martin Zimmerman, who was chief economist and executive director at Ford Motor Company. And he says this: I cannot think of an industry more cyclical and more dependent on the business cycle than the auto industry. A good year in the industry is sales of 15 million units. We are now selling above that, 2007. A severe recession is 13 million units. So a drop from 15 to 13 million, a little over 15%, is really the difference between decent performance and severe losses. If I bring that back to here, a 15% decline here is 270 revenue and brings to losses of 10 versus 20 billion, less investments, worse positioning, etc., etc. So wait for a recession if you must buy car stocks. And then the Arno here, Antlitz CFO, says that they are in a challenging environment. They have not seen a challenging environment for more than a decade in Europe and 15 years in North America, as we discussed in this video, discussing how we haven't seen a recession for 10, 15 years, and that's not priced into these car stocks. So accept the risk that it can get much, much more ugly on their leverage, on their leasing, financing, sales, huge investments into expected production year by year. So be very careful with this. We have Europe recession, maybe even US, China competition, and therefore I'm saying here, too risky, too risky, too risky, but that's me. What can I say? I'm a value investor. I like to put those chips and wait for the right time to invest. If you are like that, subscribe to this channel, and over time we'll find better investments. Thanks for watching. I'll see you in the next video.